Space Economy 2026, Investing the Extra-Atmospheric Infrastructure by Economia Italiacom. The space economy is being systematically mispriced by the market. Most investors still frame the sector as a capital-intensive extension of aerospace. In reality, value is rapidly shifting toward orbital data infrastructure, ground segment control, and recurring satellite-based revenues, segments where margins scale nonlinearly and barriers to entry are structurally high. This creates a clear analytical opportunity in space stocks 2026, particularly in companies positioned at the infrastructure layer rather than pure launch services. In this analysis, we apply our proprietary 12-point investment framework to identify where this mispricing is most evident, starting with Leonardo SPA LDO MI, a company transitioning from industrial manufacturer to critical space data infrastructure provider. 1. Leonardo Stock Analysis 2026, Valuation, Catalyst, Risks 1, Initial Setup Ticker, LDO, MI Market Cap, €36. 0.5 billion sector, Aerospace, Defense, and Space Services Cycle Phase, Expansion of High-Margin Digital Space Services. Equity Story. Leonardo is a cornerstone of the Space Alliance. It has successfully transitioned from a hardware manufacturer to an integrated provider of orbital data and satellite management. 2. Peer reality check. Leonardo's primary European peers are Thales and Airbus. Historically, Leonardo has traded at a discount. As of April 2026, it trades at an EV/EBIT of 8.0x, while Thales commands 10.5x. This gap represents a significant relative mispricing, considering Leonardo's superior positioning in ground segment data management. 3. Business quality and unit economics value creation. The company's ROIC consistently exceeds its WACC, indicating clear economic value added. Incremental margins. The space and cyber divisions are achieving scale. Unlike heavy manufacturing, every additional gigabyte of satellite data managed carries a near-zero marginal cost, driving exponential margin expansion. 4. WACC and cost of capital beta, 1.10. Implied WACC, 5.1%. Stability is guaranteed by long-term ESA and EU contracts, which provide high revenue visibility and low default risk. 5. Capital allocation strategy management has prioritized high-tech manda over generic expansion. The dividend has been raised to 63 cents. Signaling strong internal cash generation and a commitment to shareholder returns. 6. Fundamental catalyst short-term. Expected new contracts for the Copernicus Environmental Monitoring Program. Mid-term. Full integration of the Michelangelo Dome. Expected to trigger a valuation re-rating. 7. Explicit valuation intrinsic value. Estimated at €74. Reverse DCF analysis. At the current price of €62.26, the market is pricing in nearly zero growth post-2028, an unrealistic scenario given the current European rearmament and space sovereignty cycle. 8. Expectations versus reality consensus views Leonardo as a traditional industrial defense contractor. The reality, Leonardo is becoming a data-centric space company. The market is failing to price the recurring revenue streams from satellite constellations and secure orbital communications. 9. Scenario analysis. Leonardo SPA scenario key event target price probability bear ESA budget cuts project delays €55, 15% base consistent growth in backlog €72, 65% bull space. 6G leadership cyber dominance €88, 20% expected value, €69.80. Forecast based on 2026 institutional data. 10. Risk analysis. A primary risk is execution risk on large-scale international programs. However, with an investment-grade rating and strong institutional backing, the downside is floored by the strategic nature of the asset for the Italian government and the European Union. 11. Management and incentive. CEO Roberto Cingolani has successfully pivoted the company toward a physical-digital dualism. Executive incentives are now strictly tied to free operating cash flow and digital transformation milestones. 12. The analytical edge. The hidden space value. The market evaluates Leonardo using low industrial multiples. The true analytical edge here is recognizing the multiple re-rating potential. As Leonardo launches the Michelangelo Dome, it transforms into a provider of critical digital infrastructure. Investors who understand that Leonardo controls the ground gateway for global data access will realize they are buying a high-tech toll road business at a discount industrial price. Decision by upside potential, plus 18 to 22% too. Northrop Grumman Stock Analysis 2026. Valuation, Catalyst, and Space Defense Monopoly 1. Initial setup ticker. NOC current price. $512.40 market cap. 68.5 billion euro cycle phase. Maturity with structural growth. Equity story. An aristocratic defense corporation that has successfully pivoted into space intelligence. It stands as the global leader in solid rocket propulsion and secure communication satellite systems. 2. Comparative analysis direct competitors include Lockheed Martin and L3 Harris. Northrop Grumman currently trades at a forward PE of 16.5x, a slight premium compared to LMT. This valuation is justified by higher exposure to long-term NASA contracts and superior capital profitability. 3. Business quality unit economics, ROIC versus WACC. ROIC stands at 12.8% against a WACC of 5.2%. The capacity to generate value above the cost of capital is among the highest in the A&D sector. Pricing power, extreme. As essentially the sole supplier of large solid rocket motors, NOC operates within a natural quasi-monopoly for heavy-lift launch boosters. For WACC and cost of capital beta, 0.72, a low volatility stock, ideal for stabilizing portfolios during macroeconomic turbulence. Cost of debt, exceptionally low due to a solid investment grade rating and predictable cash flows. This allows for favorable refinancing rates despite the current Federal Reserve landscape. 5. Capital allocation. NOC is a corporate cannibal. The company allocates over 100% of its free cash flow to dividends and buybacks, consistently reducing the share count and mechanically increasing earnings per share. 6. Key catalysts 3 months. Updates regarding the Artemis 3 program milestones. 12 months. Full-scale implementation of contract for next-generation SDA satellites for hypersonic missile tracking. 7. Explicit valuation estimated fair value. $565. Upside. Plus 10% capital appreciation, plus 1.6% dividend yield. Expected total return, 11 to 12% with a highly conservative risk profile. 8. Expectations versus reality market sentiment fears that U.S. public debt may lead to NASA budget cuts. However, the reality is that the competition with China ensures the space budget remains a shielded, bipartisan national security priority. 9. Scenario analysis, scenario operational driver, target price probability, bear bipartisan post-election NASA budget cuts, $440, 15% base maintenance of current orders, and constant buybacks, $545, 70% bull, Space Force. Acceleration and hypersonic defense, $620, 15% analysis based on discounted cash flow models updated to April 2026. 10. Risk analysis, concentration risk. Over 80% of revenue is dependent on the U.S. government. Any radical shift in U.S. foreign policy could impact the stock, although the defensive nature of the business mitigates this risk. 11. Management and incentive CEO Kathy Warden has steered the company towards strict financial discipline. Management incentives are tied to EPS growth and free cash flow, ensuring optimal alignment with shareholder interests. 12. Analytical edge. The toll collector, monopoly the market's error, is viewing NOC as a generic aerospace company. The edge lies in recognizing that Northrop Grumman acts as a toll collector on the path to space. They control the intellectual property for the solid rocket motors required to put heavy payloads into orbit. Since no credible short-term alternatives exist, barriers to entry are rooted in physics and chemistry, not just capital. NOC enjoys bargaining power that secures stable margins regardless of competition among civil launch providers. Decision. Accumulate Rocket Lab Stock Forecast 2026, Great Potential, Neutron Catalyst, End Space Systems Edge. Se Leonardo rappresenta l'infrastruttura europea e Northrop Grumman il monopolio della propulsione. Rocket Lab è la scommessa sulla scalabilità industriale dello spazio. Ad aprile 2026, la società ha smesso di essere un semplice fornitore di lanci per trasformarsi in una Space Systems Company completa. 3. Rocket Lab, Leonardo Verticale della Nuova Aerospace LA1. Initial setup ticker, RKLB current price, $18.75 market cap, $9.2 billion cycle phase. Early growth scale up. Equity story. Rocket Lab stands as the only viable commercial alternative to SpaceX in terms of reliability. Its core strength lies not only in the Electron rocket, but in its space systems division, which manufactures components for nearly all global satellites. 2. Comparative analysis. The primary peer is SpaceX. Compared to competitors like Astra or Firefly, Rocket Lab boasts a proven track record of success, allowing it to trade at higher price sales multiples. This premium is justified by a trajectory nearing operational break-even. 3. Business quality unit economics, expanding margins. While launch services maintain margins of 20 to 25%, the sale of satellite components and software operates at over 40%. Vertical integration. By producing everything from engines to solar panels in-house, Rocket Lab reduces supply chain dependency, effectively bolstering the gross margin. 4. WACC and cost of capital beta, 1.85. This is a high volatility asset, highly sensitive to market risk appetite. Implicit WACC, 8.5%. This reflects the risk premium required for a company still in a phase of aggressive reinvestment. 5. Capital allocation. All cash flow is currently reinvested into the Neutron program. The company maintains a solid net cash position, thus far avoiding excessive shareholder dilution. 6. Key catalyst 3 months. Results of static fire tests for the Archimedes engine. 6 to 9 months. First orbital launch of Neutron vehicle, which will unlock the mega constellation market. 7. Explicit valuation target price, $24. Upside, plus 28% potential. Should the Neutron rocket become operational within the year, the market will likely stop pricing Rocket Lab as a small cap and start viewing it as a critical infrastructure pillar. 8. Expectations versus reality consensus. The market still perceives it primarily as a small launch provider. Our thesis: the satellite division is outpacing launch growth. Rocket Lab is essentially a space manufacturing firm that possesses its own rockets to deliver its products. 9. Scenario analysis. Scenario key event target price probability bear technical failure of the first Neutron launch $9.50 25% base successful Neutron launch and Space Systems growth $22 55% bull massive contract with Space Force LEO constellations $35 20% expected value $21.47. Valuation weighted by the probability of success for the Neutron program. 10. Risk analysis. Execution risk. The development of new launch vehicles is historically prone to delays and unforeseen costs. Any anomaly in the Electron vehicle could drain vital liquidity. 11. Management and incentives. Founder and CEO Peter Beck is regarded as a pragmatic visionary. Management incentives are strictly tied to technical milestones and financial targets. 12. Analytical edge. The system's undervaluation. The analytical edge here is interpretative. While the market remains obsessively focused on launch frequency, the sophisticated investor monitors the space system's backlog. Rocket Lab is constructing satellite buses for operators like Varda and Global Star. Consequently, regardless of who wins the rocket wars, Rocket Lab profits by providing the essential components to inhabit orbit. It is a classic picks and shovels model applied to the final frontier. Decision. Speculative buy riepilogo strategico. Space Economy 2026 azione profilo ruolo in portafoglio edge analytico Leonardo Lomedris core great metamorphosi in data company Northrop G. Low risk defensive income monopolio della propulsion Rocket Lab high risk speculative alpha verticalization pale Epiconi. Similar articles best Italian defense stocks FAQs 1. Why invest in space stocks now rather than waiting for Mars missions? The investment thesis has shifted from speculative exploration to orbital infrastructure. By 2026, the space economy is driven by immediate terrestrial needs: high-speed telecommunications, climate monitoring, and national security. Companies like Leonardo and Northrop Grumman are not betting on the distant future. They are generating cash flow today by providing the backbone for global digital and military connectivity. 2. Is the Space Race 2.0 a risk or a catalyst for private investors? It is a primary growth catalyst. Geopolitical competition between the U.S., China, and Europe ensures a floor for defense and research budgets. For an investor, this translates into recession-proof order backlogs. While traditional sectors face cyclical downturns, space-related contracts from entities like the ESA or the U.S. Space Force provide long-term visibility and a structural hedge against macroeconomic volatility. 3. How do I distinguish between space hype and value? Avoid PowerPoint companies with no flight heritage. Focus on unit economics. Look for a positive ROIC and a clear path to free cash flow. A leader like Rocket Lab is valuable because it verticalizes production, making its own satellites, rather than just selling launch tickets. True value lies in the picks and shovels, rather than just the rocket itself. For what is the main risk? Technical failure or capital dilution? While a launch anomaly creates short-term volatility, capital dilution is the real silent killer for retail investors. Many small-cap space stocks require constant equity raises to fund R&D. Stick to space aristocrats with solid balance sheets or companies that have already crossed the Neutron class scale-up threshold. Ensure the management incentives are aligned with EPS growth, not just successful launches.